Good day! I am back again with another concepts video for our module number 2, which is all about activity-based management. For this topic, I focused my review on understanding the concepts in ABM and how to relate those concepts in the charts provided in the chapter. First is, what is activity-based management or ABM? ABM is a system-wide, integrated approach that focuses management's attention on activities with the objective of providing customer value and the profit achieved by providing this value. You might be thinking if ABM has something to do with ABC, or are those two similar? Well, ABM is far more comprehensive compared to ABC, and the latter is the main source of information for ABM. For a recap, ABC or activity-based costing is a costing method that identifies activities in an organization and assigns the cost of each activity to all products and services according to the actual consumption by each. This model assigns more indirect costs or overhead into direct costs compared to conventional costing. In ABM, the following steps or processes are being done. First, it provides information about the resources. Second, it provides needed information with regards to the different activities being done. And lastly, information about objects of interest such as products and customers. Where all of these processes form part of the cost dimension of ABM with the objective of improving the accuracy of costs assignments and could be helpful for product costing, strategic cost management, and tactical analysis. Simultaneous to the processes mentioned earlier, there are several processes that are being done. First of which is driver analysis, which provides information about why a certain activity is being done. Then, same in the cost dimension, providing information with regards to different activities being done. And lastly, performance analysis, in which assessment on how well the activities are being performed. These processes form part of the process dimension of ABM, where the main objective is cost reduction and provides ability to ABM to engage in and measure continuous improvement. ABM has two broad objectives. First is improving decision making by providing accurate costs, and second, reducing costs by encouraging and supporting continuous improvement efforts. Implementing ABM involves two systems, which are process value analysis and activity-based costing. Between these two systems, systems planning and identifying, defining, and classifying activities are common to both. The first broad objective pertains to ABC, while the second one pertains to process value analysis. Now let's dig in deeper with systems planning. Systems planning addresses the following issues. Number 1, the purpose and objective of ABM system. Number 2, the current and desired competitive composition. Number 3, business process and product mix. Number 4, the timeline. Assign responsibilities and the required resources for the implementation. And number 5, the ability to implement, learn, and use information. The next process on the list is identifying, defining, and classifying activities. This process involves making the activity dictionary detailed, with regards to the tasks and definition of a certain activity. It also provides the importance of knowing tasks, where it can be helpful for providing the efficiency of value-added activities And lastly, allows ABM to connect with other continuous improvement initiatives. Since we are done discussing the similar processes between the PVA and ABC, let us now proceed with the process value analysis. Process value analysis is fundamental to activity-based responsibility accounting. It focuses on accountability for activities rather than costs, and it emphasizes the maximization of system-wide performance instead of individual performance. It includes the following processes. The first one is assess value content of activities. Second, define root causes of each activities. Third, establish activity performance measures. And lastly, search for improvement opportunities. For the first process under PVA, which is assess value content of activities, it is also same with activity analysis. Activity analysis is a process of identifying, describing, and evaluating the activities of an organization performs, wherein the theme of this process is waste elimination. The expected outcomes for this process are knowing the following. Number 1, what are the activities done? Number 2, how many people perform the activities? Number 3, the time and resources required to perform the activities. And lastly, the assessment of the value of the activities to the organization, including a recommendation to select and keep only those that add value. This process also includes classification of activities, which involves categorizing whether an activity is a value-added activity or non-value-added activity. Value-added activities are the activities necessary to remain in the business, which consist of mandated and discretionary activities. Discretionary activities are considered as value-added if it satisfies all three conditions. The first one is the activity produces a change of state. Second one, the change of state was not achievable by the preceding activities. The third one, the activity enables the other activities to be performed. Next is non-value added activities, which are all activities other than those that are absolutely essential to remain in the business, hence considered as unnecessary. Non-value activities fall under 5 major categories, which include the first one is scheduling, wherein we determine when different products have access to processes. Number 2, moving, wherein we move materials, work in process, and finished goods from one department to another. Number 3, waiting, wherein we are waiting on to the next process. Number 4, inspecting, wherein we are ensuring that products meet the specifications. And lastly, storing, wherein we held the products in inventory. Second process under PVA or process value analysis is defining the root cause of each activity, which is the same with driver analysis under process dimension. Driver analysis is the effort expanded to identify those factors that are the root causes of activity costs, wherein root causes are the most basic causes for an activity being performed. Third process is establishing activity performance measures, where activity performance measures involve assessing how well activities and processes are performed and is fundamental to management's effort to improve profitability in assessing well an activity is being performed and the results achieved. It also includes the following dimensions. First one is efficiency, which is the relationship of an activity inputs to activity outputs. The second one is quality, which is concerned with the doing the activity right at the first time. And lastly, time, wherein we determine how long is it required to perform an activity and the ability to respond to customer demands. Now let's talk about the measures of activity performance, which includes the first one, which is value and non-value added activity cost reports. The second one is trends in activity costs, where activity improvement is measured by cost reduction, and so we should see a decline in non-value added costs from one period to the next, provided the activity analysis is effective. The third one is benchmarking, wherein different units that perform the same activities are being compared. The unit with the best performance for a given activity sets the standards, and it is necessary to ensure that activity definitions and activity output measures are consistent across the units. The fourth one, which is life cycle costing, which would be further discussed in the subsequent modules. And then the last one, which is Kaizen standard settings. Kaizen, or continuous improvement cycle, and the maintenance cycle reflects the planned improvement for the upcoming period. It is where plan, do, check, and act correspond to the Kaizen subcycle, and standard, do, check, and act correspond to the maintenance subcycle. Now, placing all of the processes under PVA will look like this, and these processes are being done to reduce cost, where cost reduction methods normally include activity elimination, activity selection, activity reduction, and activity sharing. Now let's place all the processes that are being done under ABC. ABC costing also involves supplier costing and customer costing. The supplier costing involves assigning the costs of supplier-related activities to suppliers and help manager identify the true cost of its suppliers, while customer costing involves assigning costs of customer service to customers. The manufacturing costs are assigned to products and customer. The processes under ABC are being done to improve decisions, to reduce cost, and help in increasing profitability. Now on to the last topic, which is activity capacity management. Activity capacity management is the number of times an activity can be performed and is measured by activity drivers and capacity variances. The capacity variances are activity volume variance and unused capacity variance. Now, since we are done discussing the concepts under ABM, let us now proceed in applying those concepts through different problems. So for problem 1, let me read the problem to you. Sanjagil Incorporation has 5 production activities: cutting, assembly, finishing, inspection, and packaging. Cutting, assembly, and finishing are important, while the remaining activities are not necessary. The following data pertain to the 5 activities. For cutting, the activity driver is materials cut. The SQ, or the standard quantity, is 400,000. AQ, or actual quantity, is 450,000. And for SP, or standard price, it is 10. For assembly, the activity driver is assembly hours. SQ is 150,000. AQ is 160,000. SP is 9. For finishing activity, the activity driver is number of finished goods. SQ is 300,000. AQ is 350,000. SP is 7. For inspection activity, the activity driver is the number of inspected goods. SQ is 0. AQ is 350,000. SP is 12. Packaging, The activity driver is the number of goods packaged. SQ is 0. AQ is 350,000. And lastly, SP is 11. So the requirement for this problem is to prepare the value added and non-value added cost report for the year ended December 31, 2020, assuming that the actual price is equal to the standard price. So before we solve this problem, let me show you how to prepare a value added or non-value added cost report. So first you have to place, of course, the heading for the report, which is on the first line we will put the name of the company, and then for the second line we're going to place the type of report that we're going to do, which is the value added and non-value added cost report. And then for the last line we're going to indicate for the year ended and for whatever year it is needed. And then we're going to have 4 columns. The first column is for the activity, the second column is for the value added costs, the third column is for the non-value added costs, and for the last column that would be for the actual costs. So under the column, the first column rather, which is for the activity, we're going to list down all of the activities. And then for the value added costs, we're going of course we're going to place there the value added cost for each activity, which is computed by standard price multiplied by standard quantity. And then for the non-value added cost, or the third column, we're going to place all of course the non-value added costs for each activity, which is computed by actual quantity less standard quantity, and the difference is multiplied with the standard price. And then for the last column, we're going to place there the actual costs for each activities, which is computed by actual quantity multiplied by standard price. As you can see on the top of the report, you will see a visual representation on how to compute for value added and non-value added costs. So there is a line here, and then for the leftmost side of the line, we're going to put there the actual quantity, which stands for AQ, and then in the middle of the line we're going to place SQ, which stands for the standard quantity, and then on the rightmost part of the line we're going to place SP, or the standard price. So if we're going to multiply, well, as I have mentioned earlier, if we're going to multiply AQ by SP, we're going to get the total costs. And then if we're going to multiply SQ by SP, we're going to get the value added costs. And if we're going to deduct the value added cost from the total cost, that would give you the non-value added costs. So now let us try to solve the problem number 1. So as I have mentioned earlier, since we are to prepare value added and non-value added cost report for the year ended December 31, 2020, we should first prepare for the heading, or we should first place the heading for the report. So for the first line, that is the name of the company, which is Centragel Incorporation. And for the type of report, that is of course value added and non-value added costs. Cost report. And let us indicate the date for this report, which is for the year ended December 31, 2020. Well, I have already placed the activities, the value added costs, non-value added costs and total costs headings for the report. So let's just proceed in solving the values for this one. For cutting, the value added costs is computed by, of course, multiplying the SP by SQ, which is 400,000 multiplied by 10. Oops. For assembly, that is 150,000 multiplied by 9. For finishing, that is 300,000 multiplied by 7. For inspection, of course, that is 0 because the standard quantity is 0. So, and it's also the same for packaging since its SQ is 0 as well. Let's now compute for the total costs. And that is AQ multiplied by SP. So 450,000 multiplied by 10. For assembly, that is 160,000 multiplied by 9. For finishing, that is 350,000 multiplied by 7. For inspection, that is 350,000 multiplied by 12. And lastly, we have for packaging, that is 350,000 multiplied by 11. So for the non-value added cost, we could just simply deduct the total costs by value added costs. There you go. So if just going to get a total of these numbers, there you go. So the non-value added, so for the value added costs, the non-value added costs and total cost. Yeah. So here are the value added cost, non-value added cost, and total cost for each activity. And the total value added cost for Santiago Incorporation is 7,450,000. Its non-value added costs is 8,990,000 and its total cost is 16,444,000. Okay, for problem number 2, let me read the problem to you. Santiago Incorporation has 5 production activities: cutting, assembly, finishing, inspection, and packaging. Cutting, assembly, and finishing are important while the remaining activities are not necessary. The following data pertain to the 5 activities for the following year. For cutting activity, the activity driver is materials cut. Its SQ is 400,000. Its AQ is 420,000. Its SP or standard price is 10. For assembly activity, its activity driver is assembly hours. Its SQ is 150,000. Its AQ is 150,000 as well. Its SP is 9. For finishing activity, its activity driver is the number of finished goods. Its SQ is 300,000. Its AQ is 330,000 and its SP is 7. For inspection activity, its activity driver is the number of inspected goods. Its SQ is again 0. Its AQ is 330,000. Its SP is 12. Lastly, for the packaging activity, its activity driver is the number of goods packaged. Its SQ is 0. Its AQ is 330,000 and for its SP it is 11. The requirement for this problem is to prepare a non-value added cost run report for the year ended December 31, 2021. So again, before we proceed in solving this problem, let me first show you how to make a non-value added cost trend report. The non-value added cost trend report is quite similar to the first one, which is the value added and non-value added cost report. It's just that in this kind of report, we're only accounting for the non-value added costs, and we're going to compare the current non-value added cost of each activities to the non-value added cost of last year, and then we're going to get the variance or the difference of the two values. So in preparing a non-value added cost trend report, we should have, of course, again, our heading. So for the first line of the heading, we should indicate there the name of the company, and then for the second line, of course, we're going to indicate what type of report are we preparing. And for this problem, it is the non-value added cost trend report. And then for the last line, that is where we're going to indicate for the year ended. And for this problem, it is December 31, 2021. Okay, so this report consists of at least 4 columns. So for the first column, it is the activity column. It is where we're going to list all of the activities involved in the firm. And then for the second column, that is the non-value added costs for the previous year. And then we're just going to indicate all of the non-value added costs for that year in each activities. And then for the third column, which corresponds to the non-value added for the current year, so we're just going to place there all of the non-value added cost of each activities. And then the last column, which corresponds to the variance, so that is where we're going to place the difference between the previous year and the current year for each activities. So now let us try to solve for the second problem. So now let's try to solve problem number 2 here in Excel. So since we're going to prepare for cost report, again we have to do the heading. So the first line, that is name of the company, which is Santiago Incorporation. The type of report, which is non-value added cost trend report. Of course, the date, which is for the year ended December 31, 2021. I already placed the headings for each column and listed the activities as well. So for the non-value added cost for last year, which is for the year ended December 31, 2020, we could just simply copy the values from the previous problem that we have solved. So just going to copy this part. Just place it in here. Oops. Let's just total those numbers up. Okay. So for the non-value added cost for the year ended December 31, 2020. So we could just simply use the formula for computing the non-value added, which is AQ minus SQ multiplied by SP. So for this problem, for cutting activity, that is 420,000 minus 400 multiplied by 10. For assembly, that is 150 plus 150 multiplied by 9. For finishing, that is 330,000 plus 300 multiplied by 7. For inspection, that is 330 minus 0 multiplied by 12. And for packaging, that is 330,000 minus 0 multiplied by 11. Let's just get the total of these numbers. And for the variance, we will just simply deduct the 2, 500 minus 200, 350 minus only 10, 4,200,000 plus 3,960,000 and 3,850,000 less 3,630,000. Since we just computed for the variance, we have to indicate whether the variance is favorable or unfavorable. Since we could see that the non-value added for each activity decreased for the current year, it means that our variance, or the difference that we have computed, are all favorable. So that is all for problem number 2. Okay, for problem number 3, let me read the problem to you. You have been asked to analyze customers' profitability. Selling and administrative costs amount to 210,000 to serve 1,000 customers. The costs are primarily a function of the number of orders that the customers place, the invoices issued, and the after-sales service provided. 50% of the cost related to after-sales service. Small customers who place the largest number of orders provide 90% of service calls of about 2,000. There were a total of 40 large customers. Requirement is calculate the customer service cost per large customer.
So now let us try to solve for problem number 3. So in this problem, we are required to calculate the customer service cost per large customer. So it said in the problem that the selling and administrative costs amounts to 210,000. And also stated in the problem that the said costs are incurred to serve the customers. And the function of and those costs are the function of the number of orders, the invoice issued, and the after-sales service provided. So it is said that the after-sale service cost is 50% of the selling and administrative cost. So that would give us 105,000. So in order for us to calculate the customer service cost per large customer, we have to identify how much of the total number of calls pertains to the large customers and to the small customers respectively. So we said that the total number of calls is 2000. For small customers, that is 90% of the total number of calls. And for the large customers, that is 10%. So in order for us to calculate the customer service cost per large customer, we just have to simply divide the after sales service cost by the number of large customers. I mean, the total number of calls for large customers. So 105,000 divided by 200. So our cost per large customer is 525. So that is for problem number 3.
For our last problem, Christina Manufacturing has developed value-added standards for its activities, among which are the following three: materials usage, purchasing, and inspecting. The value-added output levels for each activities, their actual levels achieved, and the standard prices are as follows. For using lumber, its activity driver is board feet. Its SQ is 25,000, AQ is 31,000, SP is 10. For purchasing, its activity driver is purchase orders. SQ is 950, AQ is 1,200, and SP is 50. For inspection, activity driver is inspection hours. SQ is 0, AQ is 4,100, SP is 12. Assume that the material usage and purchasing costs correspond to flexible resources acquired as needed, and inspection uses resources that are acquired in blocks or steps of 2,000 hours. The actual prices paid for the inputs equal the standard prices. The requirement for this problem is to assume that the continuous improvement efforts reduce the demand for inspection by 30%. During the current year, actual activity usage drops by 30%. Calculate the activity volume and unused capacity variances for the inspection activity. So let us try to solve this in Excel.
Okay, so before we solve problem number 4, let me just show you my notes about the capacity variances in module 2. So, where is it? There. So, for capacity variances, as I have mentioned in the earlier parts of the video, there are two capacity variances, which are the activity volume variance and unused capacity variance. So, how do you solve for those variances? For the activity volume variances, that is computed by deducting the product of SP times SQ by the product of SP times AQ. There, as you can see. And for the unused capacity variance, you just have to simply deduct SP multiplied by AU to SP multiplied by AQ. So AQ stands for the activity capacity acquired or the practical capacity. SQ is the capacity that should be used. AU is the actual usage of the activity. And lastly, SP is the fixed activity rate. So the activity volume variance, it is the non-value added costs. So if we're going to multiply, yeah. So now let's try to solve problem number 4. Activity volume variance. So let's first multiply the SP and SQ, which are the problem that is 0 multiplied by 12. And then let's get the product of SP multiplied by AQ for the practical capacity, which is 4,100 multiplied by 12. That would give us 49,200. So if we're going to get the difference between these two, which is the activity volume variance, we would have, so since it's negative, this variance is unfavorable. So now let's compute for the unused capacity variance. Since we don't have any information with regard to the actual usage that was used, of course, by the inspection activity, we could simply compute for the actual usage of the inspection activity by multiplying SP times EQ, which we have computed earlier, which is 49,200 by 70%. So where did I get the 70%? It is 100% less the 30% drop of the actual activity usage. And that would give us SP times EU, which is 34,400. So the unused capacity variance is SP times EQ less SP times EU, and that would give us 14,706 favorable. This is the amount. There. That is for problem number 4.
Now, let us proceed to the next topics of the Module 2, which are lean accounting and target costing. Before I discuss my learnings in lean accounting, let me first discuss with you my learnings about lean manufacturing. Since, well, in my opinion, it is easier to understand lean accounting if you know the concepts under lean manufacturing. So, what is lean manufacturing? Lean manufacturing is designed to eliminate waste and maximize customer value. It allows managers to eliminate waste, reduce costs, and become more efficient by redefining the activities performed within the organization. The key points of lean manufacturing are maximizing customer value and eliminating waste. Now, let us dig in deeper with the latter, which is eliminating waste. There are different types of waste that are considered in lean manufacturing, and it commonly include the following. Number 1, defective products. Number 2, overproduction of goods not needed. Number 3, inventories of goods awaiting for further processing. Number 4, unnecessary processing. Number 5, unnecessary transport of goods. 6, waiting time. And last, design of goods and services that do not meet the needs of customers. As you can see, the main types of waste considered in lean manufacturing are inventory, services or processes that customers do not give value of. Since it is important to eliminate all types of waste in companies that implement lean manufacturing, the following ways are followed or given emphasis to achieve this objective. First one is reducing setup or changeover. Second, cellular manufacturing. Third, pool value. Fourth, pursuing perfection. Fifth, employee empowerment. Sixth, total quality control. And lastly, activity-based management. Once waste are reduced, companies most likely will be producing products of better quality, would have high productivity rates, reduced lead times, lower manufacturing costs, reduced inventory levels, and reduced setup times. It is important to identify what are the wastes considered in lean manufacturing so that managers will be able to know and decide what measures in waste reduction to be used, and not only to eliminate waste but also become more efficient and further improve their systems. Reducing wastes to zero level and continuous improvement are crucial in maximizing customer value, which is the other key point of lean manufacturing. Companies could maximize their customers' value by delivering the right product, delivering the right number of products ordered, delivering goods at the right time, and performing the tasks set at the lowest price possible. All these concepts are connected to our first topic, which is lean accounting, which I will explain further later in the video. Lean accounting would include focused value streams, changing inventory valuation, and inclusion of non-financial information in the financial statements. Now let me explain further the ways in eliminating wastes. Presented on the screen are the ways on how to eliminate waste in lean manufacturing or accounting. Let us proceed on to the first one, which is reducing setup or changeover times. Changeover is considered a waste because it is not necessary for customers. Reducing the time to configure equipment, it produces different type of products and enables smaller batches in a greater variety to be produced, and doing such decreases the time it takes to produce a unit of product or output. Also, increasing ability to respond to customer demand. The next one is cellular manufacturing. It is where manufacturing cells contain all the operations in close proximity that are needed to produce a family of products, and locating operations close to one another is a way to minimize move time and to keep a continuous flow between operations while maintaining zero inventory between any two operations. Then we have pool value. The objective of this process is eliminating waste by producing a product only when it is needed and only in the quantities demanded by the customers. Demand pulls products through the manufacturing process and no production takes place until a signal from a succeeding process indicates a need to produce. JIT, or just in time, has the same concept with pull value. JIT purchasing requires suppliers to deliver parts and materials just in time to be used in the production. Supply of parts must be linked to production, which is linked to demand. On to the next, which is pursuing perfection. The objectives of this process are zero setup times, zero defects, zero inventories, zero wastes, producing on demand, increasing a sales production rate, and maximizing customer value. Moving on to employee empowerment. Employee involvement is vital for identifying and eliminating all forms of wastes, and managers seek workers' inputs and use their suggestions to improve production processes. The style of management is that managers act as facilitators more than supervisors, wherein they develop people and their skills so that they can make value-adding contributions. Next is total quality control. This process strongly emphasizes managing quality and is essentially a never-ending quest for perfect quality. The striving for a defect-free product design and manufacturing process. And finally, activity-based management, which was discussed in detail in the first part of the video. Let me now discuss further lean accounting. Lean accounting are the concepts designed to better reflect the financial performance of a company that has implemented lean manufacturing. First one is value streams. Value stream is a series of process or activities creating a flow of value that the customer gets, and the value mentioned pertains to what the customer gets, like a product or a service of high quality. Hence, resources dedicated to value streams make it easier to trace cost to products. Next is changing inventory valuation. In costing systems, three methods are used to assign costs to individual products, which are the following: direct tracing, which is considered the most accurate, driver tracing, and allocation. Resources dedicated to value streams make it easier to trace costs to products. It is important that directly traceable costs are exclusively associated with the product and can be safely be said to belong to it. This is all for lean manufacturing and accounting. Now let us proceed to the last topic of this module, which is cycle cost management and target costing. In life cycle cost management, the following concepts are important. First is product life cycle, which is simply the time a product exists from conception to abandonment. Next is cycle cost, which are all costs associated with a product for its entire life cycle. It includes development, which is all about planning, design, and testing. Next is production, which is more on conversion activities. And lastly, logistics support, which include advertising, distribution, warranty, and the like. Next is value chain, which is set of activities required to design, develop, produce, market, and service a product. Next is whole life costs and its elements. Whole life cost is life cycle cost of a product plus its post-purchase costs. Its elements include non-concurring costs, which normally includes planning, designing, and testing. Next is manufacturing costs, logistic costs, and customers' post-purchase costs. And lastly, life cycle cost management, which focuses on managing value chain activities so that a long-term competitive advantage is created. Now for target costing. There are a lot of factors to be considered in setting a target price. However, market share objective, and product functionality are the ones that influence target price the most. Once the market share objective and the product functionality are considered and target price is set, target profit and target costs are determined and set. Products and processes are designed to meet the targets, and if the latter are not met, products and processes will be redesigned until it meets the target cost. Once the target cost is met, the product can now be produced. Now we're done discussing the lean manufacturing, lean accounting, target costing, and life cycle management. Let us now try to solve some problems with regards to those topics. So for problem number 1, the new CEO of Radco Manufacturing has asked for a variety of information about the operation of the firm from last year. The CEO is given the following information: number of units produced and sold, 500,000 units, selling price is 10, variable cost per unit is 6, fixed cost for the year is 1,500,000. The CEO has planned to reduce fixed costs by 200,000. However, the reduction in fixed cost will result in lower product quality, resulting in 15% fewer units being sold compared to before the change. To temper the sales drop from 15% to 8%, the CEO plans to reduce the selling price by 1. Requirement is, if the CEO institutes the changes and wants to maintain its current total income level, what should be the target variable cost per unit? So let's try to solve that in Excel. Okay, so let us try to solve the first problem. So in this problem, the requirement is that what should be the target variable cost per unit if the CEO institutes the changes and wants to maintain its current total income level. So before computing the very requirement of this problem, we should first make the income statement based on the original information, or the one that is before the changes that the CEO wants. So we have sales, variable cost, contribution margin, fixed cost, and operating income. So for sales, it is computed as 500,000 units multiplied by 10, which is the selling price, would give us 5 million. And then for variable cost, that is 500,000 multiplied by 6, which is the variable cost per unit, which would give us 3 million. And then the contribution is just the difference between the two, which is 2 million. And of course, the fixed cost, which amounts to 1,500,000. Excuse me. And of course, the operating income, which is 500,000. So now let's compute for the changes, which is at 8% reduction. Since the CEO wants to maintain its current operating income, so of course our operating income should be 500,000 as well. So for sales, that is 500,000 multiplied by 0.92. Why do we have to multiply it by 0.92? Because again, based on the problem, they want to temper the sales drop from 15% to 8%. So the 0.92 pertains to the reduction in sales or the units produced. And then we're going to multiply it by 10 minus 1 because it is also stated in the problem that they plan to reduce the selling price by 1. So that would give us the new sales, which is 4,140,000. So for the fixed cost, that is 1,500,000, which is the original fixed cost, less 200,000 because they were planning to reduce the fixed cost by 200,000. That would give us 1,300,000. So now we just have to work back the missing data. So this would give us 1,800,000. This should be 2,340,000. So this is the new income statement for the ones with the changes that the CEO wanted. So answering the question, we have the new variable cost divided by the new number of units produced. And then we have our target variable cost per unit. This is 500 multiplied by 0.92, and that would give us 5.09 variable cost per unit. So that's how you answer for the problem number 1. Okay, for problem number 2, Stone and Beaker are starting a new business venture and are in the process of evaluating their product lines. Information for one new product, handmade lamps, is as follows. Every 6 months, a new lamp pattern will be put into production. Each new pattern will require 11,200 in setup costs. The lamp product line incurred 48,000 in development costs and is expected to be produced over the next 6 years. Direct costs of producing the lamps averages 144 each. Each lamp requires 12 labor hours and 12 machine hours. Indirect manufacturing costs are estimated at 160 per year. Customer service expenses averages 16 per lamp. Current sales are expected to be 2,000 units of each lamp pattern, and each lamp sells for 224. Sales units equals production units each year. Requirement: prepare a life cycle income statement of Stone and Beaker's handmade lamps. Okay, so now let's try to solve our last problem, which is problem number 2. I've already placed a pro forma format for the life cycle income statement. So I'm just going to show you how to compute for the numbers. Okay. So we are required to prepare a life cycle income statement of Stone and Baker's handmade lamps. Okay, so first let's start with year 1. So to compute for that, we're going to multiply the customer sales are expected to be 2,000 units of each lamp pattern. So that is considered as our unit sales. And of course, the 2,000 units correspond for each lamp pattern. However, it is stated in the problem that every 6 months, a new lamp pattern will be put into production. So, how many 6 months are there in a year? So that is 2. So we're just going to simply multiply 2,000 by 2. And then we're going to multiply it by the selling price, which is 224. And that would give us 896,000 rather. And now let's go to the development costs. It is said in the problem that the lamp product line incurred 48,000 in development costs and is expected to be produced over the next 6 years. So our development costs as stated is 48,000. Now let's go on to the production costs, which consist of the following: setup, direct costs, and indirect costs. Okay, now for the setup costs, it is stated in the problem that every 6 months a new lamp pattern will be put into production. Each new pattern will require 11,200 in setup cost. So we're just simply going to multiply 11,200 by 2 because the 11,200 corresponds only for 6 months. I mean one pattern only, since a new pattern is put into production every 6 months. So in a year there are 2 types of patterns put into production. So our setup cost will be 11,200 for each pattern. So there are 2 patterns, so simply just multiply it by 2. And then we have the direct cost. It is stated in the problem that the direct cost of producing lamp average 144 each. So we're just going to multiply the 200,000 units by 2 to correspond for a year, and then we're going to multiply it by the average direct cost, which is 144. And that would give us 576,000 for direct cost. And then for indirect costs, it is already stated in the problem that indirect manufacturing costs are estimated at 160 per year. So we're just going to put it as is. And the total development and production cost would be 806,400. And now let's go to logistics. Logistics is related to customer service, and it is stated in the problem that customer service expenses averages 216 per unit. So again, we're going to multiply 2,000 by 2 to correspond to a year, multiplied by 16. That would give us 64,000. And the total life cycle cost would be 870,400, and our life cycle profit would be 896,000 less 870,400. That would give us 25,600. And now, let's prepare for let us prepare for the total after 6 years. So for this one, for the life cycle revenues, we'll just simply multiply it by 6. Why 6? Because it is said that the lamp product line is expected to be produced over the next 6 years. So meaning, you're going to sell it for the next 6 years as well. And of course, you're going to have your revenues. For the development costs, you're not going to multiply it by 6 because development cost is only incurred during the first year. For setup cost, you're going to multiply that by 6, and that would give you 134,400. Direct cost multiplied by 6, and that would give you 3,456,000. For indirect cost, multiply it by 6 as well, and then it would give you 960,000. And adding those numbers together would give you 4,598,400. And then for the logistics, you're going to multiply it also by 6. That would give you 384,000, and the total life cycle cost would be 4,980,400, and our life cycle profit after 6 years would be 393,600. So that's how you compute for life cycle costs, life cycle revenues, and life cycle profit. So that is all for Module 2 of MA.